If you are in the 22% tax bracket, it feels like right in the middle. Do you do pre-tax contributions to retirement, or should you do Roth? I'm going to help you make that decision. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. One of the quintessential financial planning questions is, should you Roth or not? So should you do Roth contributions to your 401k, to your IRA, or pre-tax contributions, okay? And this seemed a little bit easier when tax brackets were 10, 15, 25, and there was a lot of discussion about, well, at the 25% level, should you go pre-tax at that point, since that's such a big jump, and 25%, that's a quarter of what you're making, that sort of thing. And then when tax brackets switched a little bit, 10, 12, 22, there's like a bigger question. Well, it's not quite as clear. Should you switch to pre-tax at the 22% tax bracket or even 24%, or should you go Roth? Now, again, this is one of the quintessential reasons you should have a certified financial planner that's doing comprehensive financial planning, because your financial life is unique to you. And there are great reasons to consider pre-tax or Roth. There isn't one size fits all. But what are some of the issues? What are some of the consequences? What are some of the pivotal points that you're going to want to work through with your CFP as you arrive on the right path or to the right answer for you? Let's get into that right now. First, you've got to understand the tax equivalency principle. I mean, this sets the stage for the whole decision, okay? A certain amount of pre-tax income results in the same amount of after-tax wealth in the end, regardless of which account type it goes into, whenever tax rates remain the same. So what this means is, if you're in a certain tax rate today and you're going to be in the same tax rate in the future, the net result is going to be the same. That's the tax equivalency principle. And a lot of times, I'd start with this, a lot of times people, that's hard to grasp, okay? And there's one breakdown. I'll explain it here in just a second. But if we're just going to do simple math, $10,000 inside of a pre-tax account, if we assume no growth, if you're in the 22% tax bracket, then after you withdraw that 10 grand, you'll be left with $7,800, okay? Your 22% is going to go to Uncle Sam. Versus if you took that 10,000 and converted it and made it a Roth, then you're going to pay the tax right now. Okay, so that tax at the 22% tax rate is going to leave you with $7,800 that's invested. Okay, so tax equivalency principle means whether it's pre-tax or Roth, it doesn't matter as long as the tax rates are the exact same. Now, where this breaks down is if you say, yeah, but if I contribute pre-tax, then I'm actually going to get a bigger tax refund. I'm going to get some money back on my taxes. And yes, that might be true, but what are you going to do with that? What are you going to do with that? If you take that $2,200 or whatever that you saved by having that $10,000 be contributed pre-tax, if that means now you've got $2,200 of tax benefit because it went in pre-tax, if you invest that, now that's a game changer. Now that changes the story problem, okay? But if you're just looking at 10 grand that's pre-tax, versus moving that 10 grand and making it Roth, it's completely equal as long as you assume the same tax rates. If you can get over that mental hurdle, then you can get over the next one as well. I hear this a lot. The same will hold true if you assume the same rates of return from those accounts, okay? So some of you are struggling with that original math. Well, wait a second, but if you apply a rate of return to that, then the math isn't going to work. No, it actually does. And let's just use really, really simple math. You've got that $10,000 that's in the pre-tax account, and over a certain period of time, it doubles. Your investment doubles. Now you've got 20 grand. You withdraw that 20 grand, paying 22% tax, okay, and you're left with $15,600 after the 22% tax is paid. So that 10 grand invested and grew to 20, you withdrew it, paid 22% tax on it, you're left with $15,600. Compare that to that 10 grand, okay, you paid the tax, and so you're left with $7,800 that's invested. And that $7,800 then doubles because it was invested in that exact same thing. So now that doubles. Well, you're left with $15,600. It's the exact same, and you can do that if it's a 1% rate of return or it doubles every 7 years or whatever. It's going to be the exact same. That tax equivalency principle applies and still holds true, depending on, as long as you've got the same rate of return. Here's also where this breaks down, just like the other one. In circumstances, this can break down. The circumstance that is, well, I'm going to invest my Roth IRA different than I'll invest my pre-tax. Yeah, you probably should, actually. If you invest in the same, the math is going to work. If you invest them differently, well, yeah, fixed income type of investments, they're going to be taxed at ordinary income rates anyway. Therefore, I should have a disproportionate amount of my fixed income investments inside IRA. I should have my growth-oriented investments since the tax benefit is on the growth. I want more growthy type of investments in my Roth. Yeah, you're probably going to have those investments invested slightly, or those accounts invested slightly differently. But just for comparison's sake, as you're striving towards making this decision about should you Roth or not in the 22% tax bracket, it doesn't matter which account it's in, as long as the investment return is the same. Okay, that tax equivalency principle is still going to hold true. So it really ultimately, with those two pivotal points sort of instilled and understood, it really comes down to, are you going to be in a higher or lower tax bracket in the future? Are you going to be in a lower tax bracket or a higher tax bracket? If out there in the future you're going to be in a higher tax bracket than the 22% tax bracket, then I would argue do Roth in the 22% tax bracket. Now, why might you be in a higher tax bracket out there in the future? Well, there's a few different reasons. You could look at your income sources and say, yeah, our income's going to be a little bit higher in retirement. We're going to have, X amount going on, and therefore I do think we'll be in a higher tax bracket in retirement. And that's one, income could be higher. Two, I think tax rates are going to be going up in the future. Or three, I think there will be new taxes created in the future. Those could all suggest, well, at the 22% tax bracket today, that's actually lower than the tax bracket I'll be in the future, and therefore I should do a Roth instead of pre-tax contributions. Therefore, you've got to do the planning work with your certified financial planner. You might be thinking, well, how will I know if my income will be higher in the future or if I'll be in a higher tax bracket? We don't know if the government's going to raise tax rates or if there will be new taxes created. The trend certainly suggests there will be. However, from financial planning, you can actually do the math to say, well, based on your current savings rate and a presumed rate of return over a long period of time, you should have X amount out there in retirement. Your Social Security would be this, you'll be spending this, therefore you'll be withdrawing this, and blah, blah, blah. You can figure out, all right, based on current tax brackets and current tax rates, here's where we expect you to be compared to where you are right now. Is it likely that you're going to be in a higher tax bracket or a lower tax bracket? You can do that math. That's part of the planning work that you're going to do with your certified financial planner. And then you guys can have that discussion about, well, do we think tax brackets or tax rates will be higher? Do we think the current trend will continue, that new taxes will be added and the IRS will sort of be expanding their reach and trying to tax more things? So to me, in a down market, which is what we've been in right now, advantage Roth. And to me, I do look at the 22% tax bracket, even the 24% tax bracket in many people's situations say, gosh, I still like the Roth. But it's got to be applied to your specific situation. If you do the math and you look and forecast out 5, 10 years, 15 years, whatever, when you're in retirement and say, well, we're going to be living off a little bit of this and Social Security, and that's probably, this is the lifestyle we've had for a long time, and therefore that will give us all the income we need. And you do the math and say, well, geez, you're going to be squarely in the middle of the 12% tax bracket. Then you got to go pre-tax if you currently find yourself in the 22% tax bracket. I've seen this, guys, countless times in my career. I'm helping people withdraw money right now and pay tax at the 12% when I remember, and I'm pointing out to them, hey, remember when we were stuffing this into your 403B, your 401k, your single K profit share, and avoiding 25 and 28% taxes? Isn't it fantastic that we're now pulling it out and only paying 12? You've got to work with your certified financial planner, and oftentimes doing that math, it's wise to have some tax diversification, where you've got some pre-tax, some Roth, can depend on your overall financial situation and the unique situation you're in a given year or given environment, given season in retirement to determine where does it make the most sense. Work with your CFP on that, help answer and have confidence in the age-old question, should I do Roth at this tax bracket, 22% tax bracket in this example, or pre-tax? Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.